Crypto networks are proving their worth as a neutral technology platform. We're seeing donations of both Bitcoin and Ether to the Ukraine. I think it's 50 million, if I'm not mistaken, in the last week. And we're also seeing Bitcoin as a currency hedge for Russian citizens who are watching the ruble get hammered here. These are not the oligarchs. In fact, as we were discussing at our brainstorm today, there's not enough Bitcoin out there for the oligarchs to hedge, and they have been hedging for years anyway. This is for the average Russian citizen who actually is aghast, many of them, as we hear it, aghast at what's going on in Russia. Tesla is providing free supercharging. In Poland, Poland's taking in, of course, a lot of refugees. And of course, we know that longer term, electric vehicles are going to help with the demand destruction of oil. I think the prices alone will destroy a lot of demand for oil and accelerate the shift to electric vehicles. Commodities, they're on fire. We believe this is a supply problem, much more than a demand problem. I'm sure there's a scramble to build inventories of anything now, anything in the energy complex, any of the metals that come out of Russia, food out of the breadbasket of the Ukraine. Interestingly, the commodity price increases are in the face of the dollar increasing. The dollar increasing tends to put pressure on prices, but this supply problem and maybe inventory hoarding is overcoming that. The dollar is going up because it's a flight to safety currency, and we're also seeing other flights to safety. So the dollar's up about 2.5% since the end of January, when the Russia-Ukraine issues were becoming more obvious. And then the other two flights to safety we've seen, Bitcoin 6.1% and gold 8.3%. So those are the markets. What we think is going on, that innovation is accelerating. Now, onto the markets. I'll give you the top and bottom sectors, at least for the S&P 500, over, year to date. Energy is the only sector that's up. It's up 33%. And consumer staples and utilities are fill out the top three. They're down just a bit. So that's an interesting combination. Energy, we know what's going on there. Staples is a very defensive sector. That says that investors are becoming somewhat concerned about the economy. And utilities are interest rate sensitive. So when interest rates go down, utilities dividend yields look better and better, so they tend to outperform. Now, in a rising inflation environment, interest rates are not supposed to come down. And at the short end of the curve, they are not coming down, but at the long end, they are, and we'll get into that in a bit. The worst performing sectors are associated with the consumer. Again, I think the loss of purchasing power is a big problem for the consumer. So consumer discretionary, consumer services, and technology, which despite innovation getting a booster shot from problems, as innovation solves problems, it is a high beta sector, and so many investors just shy away from it when trouble seems to be on the horizon. As far as the bond market, the long treasury bond yield peaked in mid-February at 2.06 and is back down to 173. Now, what's been very interesting is the yield curve, which peaked in March of last year at, I think, roughly 160 basis points. So the difference between long-term interest rates and short-term interest rates, 160 basis points. That was a reflection of easy monetary policy, short rates being much lower than long rates. The fear is that the Fed is going to increase a number of times. We're seeing short-term interest rates up a lot, certainly in the context of recent history. But long rates not going up as much. And so the yield curve has compressed to 25 basis points. We're getting close to an inverted yield curve, meaning long rates below short rates. And that is often a sign that the Fed is too tight and real growth is going to disappoint and inflation is going to be lower than expected. We think that is the case, and we've thought so for some time. High yield spreads, so the difference between high yield bonds, interest rates, and treasury bond yields, they are moving up and corroborating that outlook. Now they haven't spiked, and it doesn't suggest duress out there yet, but they're not much above pre-COVID levels, indeed. But if they move up rapidly from here, we will be in a territory that would suggest that some companies are finding it difficult to service their debt. In other words, their business is falling off. The Fed would raise interest rates. He also did say, when asked the question in his testimony, that he would get aggressive if inflation seemed to be embedding into the system in a 70s-like scenario. Well, we thought about the analogy to the 70s, and we know a lot of, especially old-time investors who were around during the 70s, are forecasting just that, inflation embedded in the system at a much higher than expected rate. We are not expecting that. Why? It comes back to this concept of velocity, the rate at which money turns over. So I did a little more homework on velocity in the 70s. Actually, the increase in velocity started in the 60s. And in the fourth quarter from the fourth quarter of 64 to the first quarter of 81, velocity increased 21%. So the rate at which money turns over in the economy. And what that meant at that time, at least, is many people used to buy, as soon as they got more income, they would buy goods and services, and especially goods, right away, as quickly as possible, because they were afraid prices would go up or interest rates, in the case of cars and other durable goods, would go up. So buy now before prices and interest rates go up.